Welcome to the CFA Level 1 Practice Test 1. Domain, Portfolio Management, Part 6. What does a standard yield curve represent? A. Coupon rates and time to maturity for bonds of varying credit quality. B. Yields to maturity and time to maturity for bonds of similar credit quality. C. Current yields and call dates for bonds from a specific industrial sector. D. None of the above. Answer is B. Yields to maturity and time to maturity for bonds of similar credit quality. Which statement correctly explains asset correlation and portfolio risk benefits? A. Correlation influences expected portfolio return. Lower correlation means higher return. B. Perfect positive correlation results in lower portfolio standard deviation than weighted average. C. Correlation less than 1 reduces portfolio risk below weighted average, showing diversification benefits. D. None of the above. Answer is C. When correlation between assets is less than 1, diversification lowers portfolio risk. Can firms exclude underperforming discretionary portfolios from GIPS presentations? A. Yes, GIPS allows strategic composition definition. B. No, all actual fee-paying discretionary portfolios must be included. C. No, because GIPS standards are voluntary and firms may choose what to present. D. Not applicable. Answer is B. A GIPS requires all actual fee-paying discretionary portfolios to be included in at least one composite. Based on CAPM and Jensen's alpha, which stocks are undervalued or overvalued? A. Stock Z is most attractive due to lower risk implied by its SML position. B. A stock X is superior but info for stock Y and Z is contradictory. C. Stocks X and Y undervalued and worth adding, stock Z overvalued and to avoid or short sell. D. None of the above. Answer is C. Stock X and Y are undervalued, stock Z is overvalued based on CAPM and Jensen's alpha analysis. Which sensitivity analysis best shows portfolio risk changes for two assets? A. Change expected returns only keeping parameters constant. B. Adjust individual asset risks with fixed correlation and weights. C. Vary allocation weights across plausible correlation coefficients. D. None of the above. Answer is C. Portfolio risk varies most insightfully by changing weights and correlations. What distinguishes open-end mutual fund shares from closed-end fund shares? A. Open-end shares trade on exchanges daily. B. Open-end shares bought from and sold to fund company directly. C. Open-end shares issued in limited quantity at inception. D. Not applicable. Answer is B. Open-end fund shares are bought from and sold back to the fund company directly. Which statement best describes return potential of preferred stock versus call options? A. All preferred stock has unlimited upside, call option limited profit. B. Both offer similar upside driven by company profitability. C. Call options can yield higher percentage returns, preferred stock capped by fixed dividend. D. None of the above. Answer is C. Call options provide leverage and potentially higher returns. Preferred stock returns are capped. What is the approximate required nominal return to maintain real portfolio value with 4% withdrawal and 2.5% inflation? A. 4%. B. 6.5%. C. 6.6%. D. Not applicable. Answer is B. Adding withdrawal and inflation rates yields 6.5%, the nominal return needed. Which advisor action is a likely violation of CFA diversification standards for a client heavily invested in employer stock? A. Recommend investing more in employer stock. B. A. Build portfolio with U.S. large and small cap stocks with correlation less than 1. C. Include international stocks and U.S. bonds with low or negative correlations. D. None of the above. Answer is A. Further concentration in employer stock violates diversification principles. The requirement for immediate fund access to cover emergency repairs is which investment constraint? A. Liquidity. B. Time horizon. C. Legal and regulatory. D. Not applicable. Answer is A. Liquidity constraints arise from needing quick access to cash for emergencies. Thank you for watching. For more learning videos and tutorials, subscribe to BISP Trainings.